Data today shows South African inflation rate remains unchanged at 4.6% in September, as the Reserve Bank remains on a gradual normalisation path. I'm joined on the phone today by Alan Chone, inflation trader at Rand Merchant Bank. So Alan, South Africa's annual inflation rate was unchanged last month, remaining within the central bank's target band, though many were expecting a slight rise. What's your takeaway from today's data?
Well, essentially, we came in at the lower end of the expectation range. Chatting to our economists, their take out of it is that the consumer is slightly under pressure, and hence there's less pressure from their side to push inflation higher. The underlying inflation trend was obviously counteracted by the the lower petrol price. So all in all, we sat with a flat month-on-month rate, and inflation came in at 4.6%, which is, as I said, on the lower side of the RAS. The house view was at 4.8%, but they did say it's wavering between 4.8 and 4.7. Their view is if we did see anything higher than their expectation, it would be significant to move the market a little bit. But if their view is we're pretty much at the bottom end of the range of expectations.
The Reserve Bank has taken a gradual approach in tightening monetary policy, forecasting inflation will breach the 3% to 6% target band next year. Has today's data indicated that perhaps the central bank's inflation outlook is too high?
We're all pretty much of the opinion that we will see a breach next year, more likely in the January and February months than anything else. That's largely due to base effects coming through from this year. And in terms of the expectations, though, we do expect a revision downwards. If you look at the third quarter Reserve Bank expectations for inflation, i.e. what we've just seen was the average expectation was 4.9%, while the actual numbers came out at 4.7%. So we definitely see a lowering of the inflation expectations going forward. Unfortunately, we'll breach, but after the first quarter next year, we expect to be back within the band with a slightly decreasing trend towards the end of the year.
With factors including a slowing Chinese economy impacting South African commodities like iron ore and a Federal Reserve interest rate hike that could pull more money out of emerging markets like South Africa, how could we see the South African economy performing in the coming months?
Well, basically, those factors come through quite a bit into the rand. I think it's a broad-based emerging market story, especially with the mining countries out there. So, slowing Chinese economy, obviously, it's not great for our mining sector in terms of the fact that they're not as much of a buyer of minerals. But we are in a situation where we're sitting with low economic growth, and ultimately, we don't expect that to be changing very soon. I don't think the world is in much of a space in terms of a massive growth phase. So, we will be kicking the can down the road for a while, and we will see growth, not necessarily in the mining side as much, but we will still be ticking over it, but just not at a massive rate.
And are there any other factors you're taking into consideration?
In as much as they come through, obviously Europe is a large trading partner of us. It's taken a large section of our exchange-weighted rand, so we do look at what's happening over there as well. But again, we're not seeing much of assistance coming through from their side. We're not really out of the slumps yet, it seems, and we are likely just to continue grinding forward. It's not necessarily a happy story, but it could certainly be a little bit worse as well.
That was Alan Chone with me there from Rand Merchant Bank. Now, for more news and analysis like this, make sure you keep tuning in to Dukascopy TV. For now, though, it's goodbye.